So the overall investment approach that we take to investing in emerging markets is primarily a top-down driven approach. We believe emerging markets go right or wrong at the country level. So we've seen some phenomenal changes in places like China and Brazil and other countries. But on the other side, we've also seen what can happen to countries like Argentina, Zimbabwe and Venezuela. So we think it's very important to identify which countries you want to invest in and why. So we're looking for a portfolio of around 50 companies. And we want companies that make sense not just from a bottom-up company point of view, but that fit in with our country approach. So we decide which countries we want to invest in, what parts of those countries are interesting towards us, and then find good quality companies that benefit from the top-down macroeconomic environment we've identified. We're happy to invest in an all-cap universe. We're not really bothered about what the size of the market cap is, but what we are interested in is the liquidity. We want to be able to either get into a company or get out in a timely manner. And so we much prefer to focus on liquidity rather than market cap, which means we do have small, mid and large cap companies in the product, but our focus on liquidity tends to mean we have a bias towards mid to large cap companies.
I think in addition, one of the additional features of the way we approach the asset class is we find a lot of opportunity in companies that operate in emerging markets but aren't necessarily in the fund's benchmark, in the index. And there's only about 800 stocks in the fund's benchmark, but we have an identified universe of about 2,500 stocks, perhaps listed on NASDAQ or in London or Hong Kong, that operate in emerging markets. Many of those are large cap stocks, which, with very liquid shares. And we find a lot of opportunity for outperformance in some of those stocks. So it's a way to have a bigger opportunity pool that still remains liquid enough and with opportunities in the large mid-cap space where we tend to have more stocks. Emerging market equity involves investing in the riskiest part of the capital structure, equity in some of what have historically been riskier economies around the world. And as active managers, we're looking to take on portfolio relative risk. That's what we're paid to do. So we're certainly not looking to be risk averse, but what we are looking in our process is to be risk aware. And a key part of our portfolio construction process is to make sure that we've taken on the right level of index relative risk, and also that risk is sufficiently diversified across the names we own, so that no single stock or group of stocks dominates the portfolio's risk budget, and that the opportunity for outperformance is recognised by all the stocks in the portfolio rather than having all the risk lumped into a few stocks.